Welcome back. Today I wanted to make a quick impromptu video on a fund or group of funds I've been hearing a lot about lately and see if others are onto something or if they need to possibly reconsider. In this video, I'm going to briefly cover the investment company that is YieldMax and see what they offer and how they do versus the actual investments they track. First, let's quickly learn about YieldMax and their strategy. YieldMax is an investment company which focuses on delivering meaningful monthly yields to investors through alternative income strategies by harvesting volatility and turning a profit. While this is over my head, YieldMax's strategy is to sell short-term out-of-the-money calls. These calls are sold over a synthetic long stock position comprised of a long at-the-money call and a short at-the-money put. This combination of long call and short put options is known as synthetic long stock positions because it synthetically mimics the exposure of being long stock. Now let's go over to their website and see which funds they currently offer. As you can see here, they currently offer 4 funds with a 5th that will track Amazon on the way. These funds currently offer yields all the way from 2.8% with Apple up to 3.63% with ARKK. Now naturally, I'm skeptical of most things that seem too good to be true, but I wanted to look into these holdings to see if they are the real deal or just another hype train that everyone is boarding. Let's go fund by fund and see how the returns of these ETFs stack up versus the holding it tracks, beginning with the first one on the list, ARKK. First up, since ARKK does not pay a dividend, I wanted to look at the growth of $10,000 without reinvesting dividends to compare apples to apples. Looking here, one thing we do need to take notice of is the time YieldMax's OARK has been on the market, which is only since November 25th of 2022. Diving a little deeper into this screenshot, we can see all kinds of information from the starting price of both funds back in November to what the price was as of July 20th, and most importantly, we have the returns. In the past almost 8 months, OARK has had a total return of 6.61% with a projected annualized return of 10.23%, and that's compared to the 32.67% total return and 50.52% projected annualized return from ARKK. Lastly, and most importantly, we need to see what that means in terms of cash return. Your $10,000 investment into YieldMax's OARK would have turned into $10,661 versus the $13,267 from ARKK. Now, these funds are called YieldMax for a reason, so we need to check to see what the returns look like when you add in the generated income from OARK for the full picture, right? Well, let's look at this other screenshot. Again, we have the same time frame to review, November 25th, 2022 to July 20th, 2023, and we can see all the normal information here. Starting price and ending price, and starting shares and ending shares. But on here, since we're factoring in dividends, we can also see that we would have generated $4.54 in dividends per share with OARK, while again, ARKK does not pay a dividend, so we see that reflected with the $0 right here. Now let's check on those returns with the income reinvested. Since November, OARK has had a total return of 9.52% or an annualized return of 14.73%, which does close the gap but still underperforms the actual asset of ARKK, which returns that 32.67% and 50.52% respective returns in the same time frame. Again, let's check to see what that means in terms of the cash returns. Your $10,000 investment into OARK with the income reinvested would have turned into $10,952 versus that $13,267 from the actual investment of ARKK. For anyone at home keeping score, we're now at 1-0 in favor of owning the actual asset versus the YieldMax alternative. Now, let's try one of the hottest stocks of the year that does pay a dividend, even if it is barely, in NVIDIA and the YieldMax version of NVDY. Since both of these holdings pay out, I will skip comparing these funds without the dividends being reinvested and just look at them with the drip. Looking here, you can see that the time frame for this one is even smaller as it only goes from May 11th to July 20th, so just over 2 months. You have your normal information at the top with the starting price and ending price and the starting shares and ending shares. And since we are factoring in dividends, you can see that we would have generated $1.70 in dividends per share with YieldMax's NVDY versus that lovely 4 cents with NVIDIA. A big leg up to NVDY, bringing in an extra $1.66 per share in income, while at the same time having a lot more shares, so let's see what that does to the total and annualized returns. Since May, NVDY has had a total return of 25.3%, which is an annualized return of 131.9%, which is pretty great. But look in here, you can see that despite those great returns, it still underperforms the 59.3% total return and 309.21% annualized return of NVIDIA over that same time frame. In terms of cash returns, your $10,000 investment into NVDY with all that income reinvested would have turned into $12,530 versus the $15,930 from NVIDIA. Updating the score, we're now at 2-0 in favor of owning the actual asset versus the YieldMax alternatives. Next, let's look at a company I actually hold in my retire early account, an Apple, and its current 0.5% yield versus the YieldMax version of APLY with their 2.8% yield. Again, since both of these holdings pay out, we're going to just jump right into comparing them with the dividends being reinvested. For this one, the time frame has been expanded a little from the NVIDIA tracking fund from April 18th to July 20th, which gives us just over 3 months of data. Again, the same info up here at the top with the starting price and ending price and the starting shares and ending shares. And since we're factoring in dividends, you can also see that we would have generated 92 cents in dividends per share with YieldMax's APLY versus the 24 cents per share with Apple. Again, there is a 68-cent share advantage to APLY, which also has far more shares than that of Apple. So let's see what that does to the total and annualized returns. Since April, YieldMax's APLY has had a total return of 14.64%, which is an annualized return of 57.47%, which again, we will compare to the actual asset of Apple, which has had total returns of 16.18% and annualized returns of 63.49% over the same time frame, which again underperforms. In terms of the actual cash returns, your $10,000 investment into YieldMax's APLY with that income reinvested would have turned into $11,464 versus the $11,618 from Apple. Now, this one was by far the closest so far, but still, with that being said, the score has now been updated to 3-0 in favor of owning the actual asset versus the YieldMax alternatives. Truth be told, the real reason I wanted to do this video is for this last one. Probably YieldMax's most popular fund, TSLY, versus the holding it tracks, TSLA, which is another stock I hold, but this time in my Roth IRA. Since TSLA does not pay a dividend, let's first look at the growth of $10,000 without reinvesting dividends to compare apples to apples. Looking here, you're going to notice that this was YieldMax's oldest fund coming out on November 23rd, 2022, which is 2 days before the OARK fund we reviewed first. Again, looking deeper into this screenshot, you can see the starting and ending share price for the time period this fund existed, as well as the all-important total returns. In the past almost 8 months, TSLY has had a total return of 13.48%, which runs out to an annualized return of 20.68%, compared to the 43.5% total return and 66.72% calculated annualized return from TSLA in the same time frame. Putting that in terms of cash, your $10,000 investment into YieldMax's TSLY would have turned into $11,348 versus the $14,350 from TSLA. Again, we know that TSLA does not pay a dividend, but TSLY from YieldMax does. So let's see how much that yield was able to close the gap and see if YieldMax can get on the board with a better investment versus the actual holding. Again, we have the same time frame to review, 11/23/2022 to 7/20 of 2023, and we can see all the normal information up here, starting price and ending price, and the starting shares and ending shares. But on here, since we are factoring in the dividends, we can also see that we would have generated $5.94 in dividends per share with TSLY, while again, TSLA does not pay a dividend, so we'll see that reflected with the $0 here. Now, let's check on those returns with the income reinvested. Since November, TSLY has had a very impressive total return of 22.42%, or an annual return of 34.4%, which does close the gap, but still underperforms the actual asset of TSLA, which returned 43.5% and 66.72% respective returns in the same time frame. Again, let's check to see what that means in terms of the cash money. Your $10,000 investment into YieldMax's TSLY with the income reinvested would have turned into $12,243 versus the $14,350 from TSLA. This wraps up the score at 4-0 in favor of just owning the actual asset covered by YieldMax instead of their alternatives. Now, I did want to leave you all with some of my takeaways and some actual good news from YieldMax themselves. First, let's boost the morale by giving what some would consider to be good news. YieldMax announced on July 21st of 2023 that their option income strategy would be releasing for Amazon under ticker AMZY on July 25th. As time passes, I can provide update videos on how the funds covered in this video are doing and how AMZY performs to that date. Let me know down in the comments if that would be of interest to you. And now for some of my takeaways from this research. I was very surprised to see that none of the 4 currently available funds from YieldMax outperformed the asset that they tracked, even when factoring in that great yield that was generated by the YieldMax funds. All of which showed me that in most cases, taking the higher yield now will generally cost you in the long run. If you have time on your side and don't need the money generated from your account anytime soon, please do not feel the pressure to inflate your dividend income today to make it seem like you're closer to your goals or to show off online.
I don't care what you think.
Dividend investing is a long journey, but if done right, skipping out on $10 today can make you thousands in the future. I really hope you enjoyed today's different style of video. If you wouldn't mind leaving a like on the video to show your support, and feel free to share this video with anybody that you know that owns these ETFs or is interested in them, as you could be the friend that makes them rich. Use the comment section down below to let me know if you own any of these ETFs and your thoughts on the video. Thank you for watching, and until next time, see you.